Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Welcome to the Deep Dive. We're here to cut through the noise and give you the essential knowledge on complex topics. And this week, we're sifting through a really frantic period for global finance.
Yeah, absolutely.
We saw the U.S. Fed, the Bank of England, Bank of Canada all making major rate decisions. And this happened, right alongside some crucial inflation and employment data releases.
It really felt like economic whiplash, didn't it?
Yeah.
I think our mission today, for us, is really to unpack this narrative that emerged about a global shift in the balance of risks.
Right.
We need to understand the conflicting data points. I mean, why did the U.S. and Canada feel they had to cut rates? Why did the U.K. stand firm? And maybe most puzzlingly, why did global equity markets seem to, shrug it all off and hit new highs amidst all this uncertainty?
That market reaction, yeah, that's where it gets really interesting. Let's unpack the primary driver here, maybe starting with the U.S. Federal Reserve. They made their move on September 17th, 2025.
Right. So the FOMC, they went ahead and cut the target range for the federal funds rate. It was 25 basis points, bringing it down to 4% to 4.25%.
Okay.
But crucially, this wasn't really positioned as, inflation's finally beaten. It was framed much more as a risk management cut, aimed squarely at the labor market.
But isn't that the paradox here? I mean, the sources we looked at show total PCE inflation, and that's the one the Fed really watches, right?
Mm-hmm.
It remains elevated, 2.7%, and core PCE is even hotter, 2.9% through August. So inflation's still running, over 40% higher than their 2% target? Why sort of pivot from the inflation fight to focus on jobs now?
Well, I think it's because the implication of that employment data was, frankly, terrifying to them. They saw what they described as a profound rise in downside risks to employment.
Okay.
And if you look at the figures that really drove this pivot, payroll job gains had slowed significantly. We're talking an average of just 29,000 per month over the previous 3 months.
Wow, 29,000 jobs. Is
Right.
that even enough to keep up with population growth? Isn't that basically stall speed, right near what they call the break-even rate?
Exactly. That's the worry. And the fact that the unemployment rate also edged up to 4.3% in August just confirms this slowdown. The Fed seems specifically worried about this kind of low-firing, low-hiring environment.
All right.
It's not just that hiring is slow, it suggests the labor market might have lost some of its churn, its resilience.
So if a shock hits.
Precisely. If a recession or, say, another trade shock were to hit, unemployment could spike much faster because new jobs just aren't being created quickly enough to absorb laid-off workers. That vulnerability, I think, is why one member actually preferred a larger cut, a 50 basis point cut.
Ah, okay. That puts the inflation numbers in a different light then. They're essentially betting that the inflation we see now, maybe partly driven by things like tariffs, will be, quote, relatively short-lived. And the bigger systemic risk is a sudden collapse in employment.
That's exactly how I read it. They seem to be accepting these currently high prices to try and stave off what they perceive as a potential employment crisis down the road.
Okay, now let's look just north. While the U.S. is worried about internal employment softening, Canada faced a pretty significant external trade shock, right? How did that push the Bank of Canada, the BOP-ASIA, to follow the Fed?
Well, the BOP-ASIA also cut its policy rate by 25 basis points, down to 2.5%, and they did it on the same day, September 17th. Their decision seems really necessitated by sharp economic weakness, and it's tied directly to that global trade uncertainty.
How bad was it?
Canada's GDP actually declined by a pretty steep 1.5% in Q2. That's largely attributed to trade disruptions. And similar to the U.S., their labor market is also suffering. Unemployment hit 7.1% in August.
Oof.
Yeah, so when the economy is contracting and exports are falling, rate cuts become an almost unavoidable response to try and balance those risks.
So, okay, 2 North American cuts, both driven by employment and trade risks. Now let's hop across the Atlantic to the Bank of England. The BOE is, stubbornly standing apart. They maintain their bank rate at 4.0%. Why the defiance there?
It's a fundamentally different story in the UK right now. While the US and Canada are, worried about workers potentially losing jobs, the BIDI is still absolutely laser-focused on the persistent price of goods and services.
Still inflation.
Still inflation. UK CPI was 3.8% in August. And it's actually expected to temporarily peak slightly higher. maybe 4.0% in September. So that 7-2 vote to hold the rate really shows they're still dedicated to, as they put it, squeezing out any existing or emerging persistent inflationary pressures. Upside inflation risk is still their #1 concern.
That's such a fine line they're walking, isn't it? Trying to hold inflation steady while, well, much of the rest of the developed world is easing. Did they offer any kind of concession to this easing environment? Anything at all?
They did, but it was subtle, more technical. They actually slowed the pace of their quantitative tightening QT. That's the process of shrinking their balance sheet, selling off bonds.
Right.
They reduced the target pace for selling UK government bonds over the next 12 months. They slowed it to 70 billion, down from the previous pace of 100 billion.
So less tightening.
Exactly. By slowing QT, they're taking less liquidity out of the system than the market might have expected.
Yeah.
So it's kind of subtle nod toward slightly easier financial conditions, but without actually touching that core bank rate.
Okay, let's move beyond the central banks themselves for a moment and dive into some of that messy U.S. data that must have contributed to the Fed's anxiety. What makes the U.S. economic picture so, well, murky right now?
Well, the sources we looked at really show these contradictory signals. It paints a picture of an economy that seems quite uneven, actually. On one hand, yes, the labor market looks fragile based on that jobs number. But then the consumer, surprisingly, still seems pretty robust, at least based on the August retail sales data.
That's the thing. If job gains are only 29,000, who is doing all this spending? Is it all just credit fueled, or is the Fed perhaps looking at the wrong indicator sometimes?
Well, someone is definitely spending. Total retail and food services sales were up 0.6% month over month, adjusted seasonally, and year over year was pretty robust 5.0%.
5% year over year.
Yeah, but the growth seems highly concentrated in certain areas. For instance, non-store retailers.
Yeah.
You can think of that as mostly online shopping, probably dominated by giants like Amazon. They jumped 10.1% year over year.
Wow.
And food service and drinking places, so restaurants and bars, they were up 6.5% year over year. So this does kind of contradict the idea of an immediate, widespread consumer pullback. It suggests maybe high income spending, or at least essential spending, remains pretty strong.
Okay, and then we also had the UI claims data. Initial claims, they fell sharply for the week, ending September 13th. On the surface, that looked positive, right?
Yes, initial claims dropped to 231,000. And yeah, that looks like short-term stability. However, the Fed seems focused on the longer trend and that whole low overall hiring environment we just discussed.
Right, the bigger picture.
Exactly. Even with that sharp weekly drop, the total number of people receiving unemployment benefits, the insured unemployed, that remains pretty high at 1.92 million. So the vulnerability is still that overall lack of churn and the low job finding rate. A single week of good initial claims data, well, doesn't really fix that underlying issue.
And just to compound the confusion, the manufacturing pulse isn't exactly screaming collapse either, is it? The Philadelphia Fed manufacturing survey for September actually showed a sharp jump.
It absolutely complicates that weakness narrative. The index for current general activity rose sharply to 23.2 in September. That's the highest it's been since January. New orders also rose substantially.
So manufacturing is expanding?
Regionally, at least, this suggests manufacturing activity is expanding overall. So you've got this picture: expanding regional manufacturing, strong retail sales, sitting right alongside rapidly decelerating national job creation. It really feels like an economy split right down the middle.
Okay, let's shift gears slightly for a global inflation checkup. We know the UK is still wrestling with persistence. What's the wider view? How about the euro area and Japan?
Well, the euro area has, technically speaking, hit its target. The annual HICP inflation rate remains stable right at 2.0% in August.
Oh, okay. Mission accomplished.
Not quite so fast. Core inflation, that's excluding the volatile stuff like energy, food, alcohol, tobacco, that was slightly higher, 2.3%.
And the key is always what's driving it underneath, right? If energy prices are maybe stabilizing or falling, where's the pressure coming from now?
It's overwhelmingly services. And that's really the persistent global theme we keep seeing. Services contributed the most to that annual rate, adding plus 1.44 percentage points. Food, alcohol, and tobacco added another plus 0.62 percentage points. Energy was actually a net drag, pulling the rate down slightly.
So the takeaway?
The takeaway in the euro area is that the headline 2% target kind of hides this persistent issue. Services inflation is still running pretty hot, likely fueled by wages and ongoing demand.
Okay. And finally, Japan. They've been trying to escape decades of deflation. Is their inflation push slowing down?
Yes, slightly it seems. The overall CPI for Japan, excluding fresh food, it slowed to 2.7% year-over-year in August. That's down from 3.1% in July. So while it's still elevated for Japan's historical context, the upward pressure does seem to be easing a bit compared to their recent peak.
Okay, let's try and bring this all back to the market reaction then. Investors absorbed what? 2 major rate cuts driven by employment weakness, a hold in the UK, and this really confusing mixed bag of US data. Did they panic? No, they celebrated.
They absolutely celebrated. Right after the Fed cut, U.S. indices pushed to new highs. You had the S&P 500 up 0.49%, the Nasdaq jumped 0.72%, and the Dow Jones rose 0.37% as of September 19th.
Hold on. The market is celebrating a rate cut that was fundamentally driven by rising unemployment risk. Doesn't that seem irrational? Are they just assuming the old Fed put is back in play?
Well, the market interpretation seems to be that yes, the Fed saw the risk, they acknowledged it, and crucially, they moved preemptively. It's seen as a risk management cut, and investors tend to interpret that as the Fed being highly sensitive to slowing growth and, importantly, willing to ease policy before a crisis actually hits.
Oh.
So it reinforces this idea that maybe central banks have shifted focus slightly away from fighting inflation at all costs toward prioritizing growth and financial stability, perhaps.
What's really fascinating here, though, is the currency response. Despite the Fed cutting rates, the dollar index actually strengthened a bit, didn't it? Trading around 97.27.
Yeah, and that kind of reinforces the idea that the 25 basis point cut was very heavily anticipated, maybe fully priced in already. The dollar index strength suggests that even with the cut, the U.S. outlook is still viewed as relatively stable compared to its global peers.
Where did the major pairs end up?
The euro traded around 1.1744 against the dollar, and the dollar was around 147.96 against the Japanese yen. So, yeah, it wasn't really a currency move signaling sudden U.S. weakness. It was more like signaling pragmatic policy action that was expected.
Okay, before we wrap up, what should we be looking out for next week or so?
Well, based on the investing.com calendar, we should probably keep an ear out for any comments from FOMC member Daly. She speaks on September 19th, so that might give some more color on the Fed's risk assessment.
Right.
But the next really critical moments are the actual meeting dates. The Fed and the Bank of Canada both meet next on October 29, 2025. And the Bank of England meets shortly after that on November 6, 2025.
Okay, so here's maybe the key takeaway for us all. The global economic landscape right now seems defined by the central bank divergence. You've got the US and Canada clearly prioritizing the mitigation of employment risks, while the UK remains something of an outlier, still highly focused on squeezing out that price persistence.
Yeah, and we're left with this core tension, aren't we? The market is cheering the rate cuts, perhaps seeing them as supportive, but the underlying economic picture remains profoundly murky. You've got the U.S. experiencing this low-firing, low-hiring dynamic alongside surprisingly resilient retail sales and even expanding regional manufacturing. It's confusing.
Which brings us to our final provocative thought for today. Given that the FOMC's own median forecast puts the unemployment rate at 4.5% by year-end, that's up from the current 4.3%, and GDP growth forecasts remain pretty modest. Are these recent stock market record highs really a celebration of fundamental economic strength, or are they perhaps just a reaction to central banks seemingly capitulating to slowing growth expectations?
Something to chew on.
Definitely something to think about. Thanks for watching. Don't forget to like and subscribe.